Introduction. The share market, also known as the stock market or equity market, is a place where people buy and sell shares of companies. These shares represent ownership in the company, and owning them can be a way for people to make money. Explanation. Imagine that your friend has a lemonade stand, and they need some money to buy more lemons and sugar. They decide to ask people to invest in their lemonade stand by selling shares. When someone buys a share of the lemonade stand, they own a small part of it. If the lemonade stand makes a profit, the shareholders, the people who own shares, will also make a profit. For example, if the lemonade stand makes $100 in profit and there are 10 shares, each share would be worth $10. Now, let's say that the lemonade stand becomes really popular and starts making a lot of money. More and more people want to buy shares, which means the demand for shares goes up. This can cause the price of each share to go up as well. On the other hand, if the lemonade stand doesn't do well and starts losing money, people might want to sell their shares. This can cause the demand for shares to go down, and the price of each share might go down as well. In the real world, there are thousands of companies that sell shares on the share market, not just lemonade stands. When people buy shares, they are taking a risk because they don't know for sure whether the company will do well or not. But if the company does well, the shareholders can make a lot of money. Conclusion. So, that's the share market in a nutshell. It's a place where people can buy and sell shares of companies. Owning shares can be a way for people to make money, but it can also be risky because the value of the shares can go up or down depending on how well the company is doing.